Here's the answer. Most people never get told. The reason the wealthy often pay a lower effective tax rate than a regular worker is not one secret loophole, and it is not fraud. It is 6 legal rules built into the U.S. tax system, and which one applies to you depends less on how much you make and far more on how that money reaches you. Earn $52,000 on a W-2 and your first check might say $3,421, closer to $41,000 a year after income tax, payroll tax, and withholding take their cut before you touch it. But if you own assets, operate through entities, or borrow against appreciated wealth, the timing and the character of your tax change completely. Same country, same code, different position in the game. I'll walk you through all 6 rules in order from your first paycheck to the day your assets pass to the next generation. And this isn't theory. In 2021, ProPublica obtained the actual IRS records of the 25 wealthiest Americans. Between 2014 and 2018, their combined wealth grew by $401 billion, and they paid what ProPublica called a true tax rate of just 3.4%. Over those same 5 years, a typical American worker in their 40s saw their wealth grow by about $65,000 and paid nearly $62,000 in taxes on it. The billionaires grew richer by hundreds of billions and paid a smaller share than the nurse. One honest note: that true tax rate counts unsold assets as income, which the tax code does not actually tax. So it's a provocative framing, not the official definition. But the gap is real, it's legal, and it's the 6 rules you're about to learn. Quick caveat: I'm not your accountant, and this is not personal tax advice. The right move depends on your income state structure and a professional. Talk to a CPA before acting. Now the bottom floor. You're 22, the offer said $52,000. Your first paycheck says $3,421. You do the math twice, that's closer to $41,000 landing in your life. Nearly $11,000 vanished between the offer and the deposit. Nobody warned you. The money just left before you could touch it. That's your introduction to the tax code. Not a lesson. A subtraction. The tax system isn't only about how much you earn, it's about when the tax is calculated and how much control you have first. At the W-2 level, you have almost none. Income tax is withheld. Payroll taxes come out automatically. Social Security and Medicare are taken before you decide whether to invest, spend, or build anything. The system reaches into the paycheck before the paycheck reaches you. So you take the standard deduction, $16,100 for a single filer in 2026 file online, and get a $400 refund in February. You feel relieved not realizing you overpaid. You gave the government an interest-free loan for 12 months and threw a party when it handed back a piece of your own money. Think about Sarah 2 cubicles over. She makes $58,000 and gets a $900 refund every January, which she calls free money and spends on a weekend trip. But it was never free. It was her own money held all year at 0 interest, returned late enough to feel like a reward. That's the W-2 trap. In one sentence: you don't pay what you decide to pay. You pay what gets taken. Rule 1. A W-2 employee is taxed before they spend. Business owners and investors often get to spend deduct structure or defer before the final tax is calculated. That sequence tax first or control first is the entire game. Once you see it, you can't unsee it. You're 24. You hear Roth IRA at an onboarding session you barely listened to, search it a week later, and open one online in 11 minutes. You hit the 2026 limit of $7,500, and for the first time, taxes feel like something you can plan around. A Roth is a tax-free container. You put in money that's already been taxed. It grows, and qualified withdrawals in retirement come out tax-free. Definition: Roth IRA is funded with after-tax dollars, So future growth and qualified retirement withdrawals can be completely tax-free. Run the math, $7,500 a year for 40 years at a 9% average could top $2.4 million. Markets don't move in a straight line, and 9% isn't guaranteed. But the point is the tax treatment, not the exact number. That's powerful. It's also the smallest room in the building. And let me be honest, because the comments will say it, if I don't, awareness is the first crack in the wall, but capital is what turns the later rules from theory into reality. Knowing about cost segregation does nothing if you can't buy the building. The early rules. Roth deductions S-Corp are open to almost anyone. The later ones require money to already exist. So this isn't a just learn the rules and get rich video. It's a map of what unlocks on each floor. Here's a question. Millions of freelancers. Google every April. Why do I owe more tax than an employee who makes the exact same money? 2 words: self-employment tax. Your net worth crosses $50,000. You take a side project, design, consulting, editing. A client sends $3,200. No withholding, just money in your checking account. For 2 months, it feels amazing. Then April comes. The IRS calls it self-employment income. That 15.3% is Social Security and Medicare, the half an employer normally covers. Self-employed, you pay both halves. On $3,200, that's roughly $490 you never budgeted for. You're angry for a week. Then you get curious, and you find the phrase that changes everything: ordinary and necessary business expense. The laptop, software, business mileage, a course that improves your service, a dedicated home office, potentially deductible. Take Marcus, he tracks 4,000 business miles driving to weekend client meetings, and at the IRS rate. That's thousands in deductions. He didn't spend more, he documented what was already happening. That's the first shift. The poor think taxes are punishment. The middle class thinks taxes are paperwork. Business owners learn taxes are a language. Rule 2. The tax code doesn't change only because you make more. It changes because of how you earn it. 2 people can earn the same $100,000 and live in completely different tax realities, one as wages, one as business income. So what does an S-Corp actually do, and why does every accountant push high earners toward one? It splits your income into 2 buckets, the IRS taxes, differently. You cross $100,000 combined. Your bracket is climbing, self-employment tax is stacking, and the pain is finally big enough to act. You form an LLC, elect S-Corp status, and pay yourself a reasonable salary. That word matters because the IRS won't let you pretend your labor is worth nothing. On $150,000 of profit, maybe $60,000 is salary. The rest comes as an owner distribution. Salary gets payroll tax. The distribution generally does not get self-employment tax. Definition: an S-Corp can let an owner split income between a reasonable salary and distributions, cutting self-employment tax on the distribution portion when structured correctly. That can be 5 figures a year. There's an unofficial rule of thumb accountants use. It starts making sense around $40,000 to $50,000 of net profit, because below that, the payroll and filing costs eat the savings. But here's where people get burned. I've watched someone pay themselves a $12,000 salary on $200,000 of profit thinking they're a genius. That's the fastest way to get a letter from the IRS. The agency calls it unreasonable compensation. And it's one of the most scrutinized small business issues. The strategy is real. Abusing it is an audit waiting to happen. And the deeper lesson, the most expensive thing you'll ever do is nothing. Inaction never arrives as an invoice. It just disappears into a higher tax bill. The poor lose money not knowing the rules. The middle class loses by waiting too long. The wealthy pay professionals to see the rule before the cost appears. Your business crosses $250,000 in revenue. Net worth between $300,000 and $500,000. Then your accountant says a boring word that makes you sit very still: depreciation. You buy your first rental not because of a guru in a rented Lamborghini, but because of how the code treats buildings. The IRS lets you depreciate residential rental real estate over 27.5 years. On a $400,000 building portion, that's about $14,545 a year in paper deductions. No cash leaves your pocket. The building may even rise in value, but the return treats part of it as wearing out. Definition: depreciation is a deduction for a property's gradual wearing down, letting an owner cut taxable income on paper even while the asset produces cash flow and appreciates. Now, precision, because bad videos oversell this. It does not automatically erase every kind of income passive activity rules. Your income level, real estate professional status, and active participation all matter. One rental does not magically wipe out everyone's tax bill. But for the right person with the right facts, it's powerful. Then cost segregation and engineering study that breaks a property into parts: flooring, fixtures, landscaping, that can depreciate faster than the building pulling deductions into the early years instead of spreading them across 27.5. Take Priya, a dentist with a high household income. She and her spouse buy a rental. Her spouse qualifies under the real estate professional rules. They run a cost seg study. The property cash flows positive, but the return shows a loss that offsets serious income. To a worker, that sounds like cheating. To the code, it's accounting. That's why real estate feels unreal to a W-2 employee. The employee earns money and pays tax before using it, while the property owner collects rent, deducts expenses, deducts depreciation, and shows a paper loss even while building equity. Rule 3. The wealthy don't always cut tax by hiding income. Often they convert real economic activity into paper deductions the law allows. The code isn't a wall or even a door, it's a machine. And the same dollar can be income in real life and a deduction on paper. Your business now generates $1.5 million a year. You think in entities, retirement plans, and timing. The code stops feeling like a list of rules and becomes a menu of elections. First, the solo. 4001k. With no full-time employees besides yourself and maybe a spouse, you contribute as both employee and employer. In 2026, the employee deferral is $24,500, and total defined contribution limits reach $72,000 before catch-up. Then a defined benefit plan. If your income is high and consistent, it can allow deductible contributions well into 6 figures based on your age and projected benefit, not a hack, but an actuarially designed structure used by high-income professionals. Then you hire your child for real work: photography, filing, editing social clips. You pay real wages, the business deducts them, and your child may owe little or no federal income tax within the standard deduction. Definition: hiring your child shifts income from your higher bracket into their lower one, while keeping the wages deductible only if the work is real, the pay reasonable, and the structure correct. Then the Augusta Rules section, 280. Your business rents your home for legitimate meetings up to 14 days a year. The business deducts it. The income to you may be excluded. One rule, 2 sides, 14 days. But documentation, market rate, and real meetings matter. Get greedy and you don't have a strategy, you have an audit. Rule 4. At this level, the code isn't a set of obligations, it's a set of elections. You make them or you don't, and the IRS will never remind you which ones you missed. This is where wealth separates from income. Income is what came in this year. Wealth is what survives tax lawsuits, inflation, and time. Net worth clears $7 million, and the question changes from how much do I own to where does it legally live. At lower levels, ownership is simple, everything's in your name. At higher levels, direct ownership becomes exposure. Every lawsuit, creditor, and dispute has a clearer path to you. So wealth moves into structures. A holding company sits above the operating company. A real estate LLC owns the building. A management company may provide services across the structure. Each entity has a role. Each wall has a purpose. Definition entity structuring separates ownership, liability, operations, and cash flow. So wealth is managed with more control and less direct personal exposure. None of this is exotic. It's what serious attorneys build and what wealthy families maintain quietly for years, while everyone else only sees the house and the cars. It's not about hiding. It's about separating. The wealthy stop treating money like a pile and start treating it like architecture, because the goal isn't only saving tax, it's keeping one failure from collapsing the whole building. You're no longer a person who owns things. You're a person whose structures own things. Net worth crosses $20 million and earning becomes inefficient, not because you stop spending, but because taking income triggers tax, events the wealthy are trained to avoid. So instead of selling, you borrow against your portfolio. A securities-backed line of credit lets you pledge investments as collateral and draw cash without selling. No sale, no capital gain, no recognized income, no income tax. Loans aren't taxable because borrowed money gets paid back. Definition buy, borrow, die means buying appreciating assets, borrowing against them for cash instead of selling and holding until death, so lifetime gains may never be taxed as income. The honest math, because this is where bad videos lie. The wealthy aren't dodging a 37% ordinary rate on these gains. For high earners, the top federal long-term capital gains rate is 20% plus a 3.8% net investment income tax, so it's selling and triggering about 23.8%, or borrowing and triggering no sale. And that's federal only. In states like California or New York, that tax gains as ordinary income selling costs even more, which makes borrowing look better. But this isn't free or risk-free. A market drop can trigger a collateral call. Rising rates raise the cost. The difference is, scale a normal person borrowing against unstable assets can get wiped out, while a family borrowing against hundreds of millions in diversified assets has margin advisors and time. They use debt not because they're broke, but because selling creates a tax event. Picture a founder sitting on $50 million in stock she's held for 15 years. She wants $1 million for a house. Selling means recognizing the gain and writing a 7-figure check to the IRS. Instead, she borrows $1 million against the portfolio at single-digit interest. The shares never sell, the gain never triggers, and the portfolio keeps compounding behind the loan. To the outside world, she looks like she spent $1 million. On her tax return, almost nothing happened. Rule 5. The wealthy don't only earn more. They change what they receive. Borrowed liquidity backed by appreciating assets instead of taxable income. To a worker, cash means income. To the wealthy, cash can mean a loan. Net worth reaches 9 figures. So how do billionaires legally pass fortunes to their kids without losing nearly half to estate tax? This is where the answer lives. The meeting is now with an estate attorney, a tax attorney, and a trustee. Maybe a family office. The question isn't, can we beat the market? It's, how does this survive us? In 2026, the federal estate tax exclusion is $15 million per person, about $30 million for a married couple with planning. Above that, the federal estate tax rate climbs to 40%. At 9 figures, you're miles over, so the game becomes moving wealth out of your taxable estate legally while alive. AGRAT moves appreciating assets into a trust. You take annuity payments, and if the assets beat the IRS assumed rate, the excess passes to heirs with reduced gift tax impact. An IDGT is defective for income tax, but effective for estate planning. You keep paying the income tax, shrinking your estate further while the trust compounds for heirs. The defect is the feature. A family limited partnership can support valuation discounts when interests lack control or marketability, transferring wealth at a lower taxable value. A charitable foundation removes assets from the estate, generates deductions, and keeps philanthropic control in the family. Philanthropy here can be generous and structural. That's not a moral judgment, just how the architecture works. Definition: high net worth estate planning is the legal design of ownership control, taxation, and inheritance before death, so wealth transfers by plan instead of by default. A normal family leaves behind accounts. A wealthy family leaves behind instructions. What is the stepped-up basis, and why do estate lawyers call it the most powerful line in the code? Here's the one-sentence version then, the example. You're 74. Your portfolio is worth $60 million. You never sold the core positions index funds, real estate, early equity. They were worth $4 million when you accumulated them. That's $56 million of appreciation you've never paid capital gains tax on because you never sold. Then you die. Your heirs inherit, and the cost basis, the number the IRS uses to calculate gain, generally resets to the fair market value on the date of death. Not $4 million, $60 million. Definition: the stepped-up basis resets an inherited asset's cost basis to its market value at death, potentially erasing a lifetime of unrealized gains for income tax purposes. That's Section 1014. The gain didn't vanish from reality, the asset really rose, but for income tax, the built-in gain can be wiped away at death. If the heirs sell shortly after, there may be little or no gain to report. And here's the nuance almost nobody mentions. The stepped-up basis erases income tax on the gain but does nothing for estate tax. Those are two separate taxes. That's exactly why the nine-figure crowd needs both the trusts and the step-up. Trusts handle the estate tax, the step-up handles the income tax. Miss that and you'll think one tool does the work of two. That's why buy, borrow, die is so powerful. It's not just the borrowing, it's the ending. Buy, let it appreciate. Borrow, instead of selling, die. Holding it, let the basis step up. The bill that looked deferred for decades may never arrive as income tax at all. Rule 6. The most powerful tax strategy in American wealth isn't always a trust, a deduction, or an election. Sometimes it's dying with the right assets. The middle class asks, how much tax do I owe this year? The wealthy ask, how do we keep a taxable event from happening at all? A completely different question that produces a completely different life. Somewhere right now, in an apartment that smells like takeout and ambition, a 22-year-old is opening a paycheck. The number doesn't match the offer. They do the math twice. Confused, then annoyed, then they move on because everyone moves on. Nobody told them the confusion was a door. Same tax code. Different rooms. In one, your wages are taxed before you touch them. In another, a building creates paper losses while cash flows in. In another, cash arrives as a loan. And in the last, the basis resets after death. They close the laptop. There's a project due Thursday. They don't know it yet, but that tiny project might be the first crack in the wall. Not because it makes them rich, but because it changes the question from how much will they take to what does the code actually allow. The 6 rules were always there. Rule 1 taxes you before you spend. Rule 2 changes the game based on how you earn. Rule 3 turns buildings into paper deductions. Rule 4 rewards the people who make the right elections. Rule 5 turns appreciated assets into borrowed cash. Rule 6 can erase decades of unrealized gains at death. Every floor between them is just learning how to read. The only question left, which rule are you standing next to right now, and which one are you finally ready to learn?